What is going on, everybody, and on here? And back from a week vacation. Just landed a little bit ago. And I wanted to do a video on this bullshit article about GameStop is preparing an offer for eBay. So I've gotten so many questions about this, and just the math behind it is utterly ridiculous. And before we even get into this, if you're eBay, what the hell would you want with shares of GameStop? You want nothing to do with them. All GameStop does, and this is their business model, is they sell shares of stock to suckers and Timmys and dumbasses. They don't actually have an underlying business. In fact, the underlying business doesn't produce enough cash flow to fund the debt service on the debt they have. The only reason that they can do that is because they're sitting on $9 million of cash and marketable securities that kick off a reasonable amount of interest. But that being said, there's people out there that are like, well, they can just, borrow to buy eBay or this and that. And quite honestly, in today's day and age, it's very difficult if you're a public company to be levered more than 2.5 times debt to EBITDA. And anything above that, you're probably paying double-digit interest rates, 10%, 12%, 14%. And then you get into the ugly world with warrants and convertible debt and all kinds of crazy stuff, which just muddies the waters in a transaction like this. So for those of you who don't know how acquisitions generally work, I've done a ton of these in my career, obviously not to this scale, not $50 billion acquisitions, but multiple $100 million ones. The math scales. Generally, what happens is you take a look at the company's enterprise value. In this instance, it's a public company. You know exactly what it is. eBay's market cap is around $46 million. You're going to have to pay at the very, very bare minimum a 25 to 35% premium to market. And if the stocks come down over a period of time, you may have to go a little bit above that. Because there is a school of thought where if the stock's traded above that in the last couple of years, you're theoretically impairing shareholders that could potentially be sitting on losses. But I digress. Either here nor there, the math doesn't make any sense. So let's take a look at GameStop just very quickly. So this is a website I love. It's BAMSEC. You can basically pull, and I'm not logged into this, but you can basically pull all the public filings. You don't have to go to Edgar, which is the government's online database. Everything is here in a nice, easily usable format. So here you have GameStop. First of all, the market cap of GameStop is $11.9 billion, which might seem like a lot. But if we go to 10K, and we'll just do 10K to 10K. So we're going to go down here to financial statements and disclosures, click on balance sheet. They are sitting on $9 million worth of debt and marketable securities. So the market cap is $11.9 billion. They have $9 billion of cash. The underlying business is worth very, very little. Now, if you go down here, they have just shy of $4.2 billion of long-term debt. So if you look at that from a net cash perspective, it's really $5 billion of net cash, and just call it $7 billion of actual enterprise value from the underlying company. So $5 billion may seem like a lot, but when we go look at eBay has a $46 billion market cap. So eBay is more than 4 times larger than GameStop. When you start talking takeover premium, you're getting to 5.5 times the size. So this is where the math really starts to break down. So if we scroll down a little bit further, and let's look at the income statement. So net sales for this year, $3.6 billion. Decent number, but 2 years ago it was 5.3. Last year it was 3.8. So the underlying business of GameStop is what the industry calls a melting ice cube, because it will get to an inflection point where the overall gross profit of the business doesn't cover your SG&A expenses. It just doesn't have the scale. Now, if you're growing, it works in your benefit because every incremental dollar of revenue generates gross profit that falls directly to the bottom line because you don't need to add incremental administrative cost. So that being said, if we look at the business here, your operating income, so income from your underlying operations was $232 million for 2025. $232 million for a company trying to buy a company with a market cap of 46 billion fucking dollars. So take this number, multiply it by 2, and shift the decimal place. That's how ridiculous this math is. Like a 5-year-old would understand how ridiculous this math is. So taking it a step further. So here you have interest income, $271 million. So effectively, more than 50% of the earnings of this company are coming from interest income from their pile of cash. And in addition, you have income tax expense, in parentheses, this is benefit. They're basically using a prior period loss, or for tax purposes called a net operating loss. You can carry it forward for, I think, 20 years. I don't know if they've changed the laws recently. I haven't looked at it in a couple of years. But you have $271 million of interest income from the cash that they had sitting there doing nothing, and $34 million of income tax benefit from prior period losses. So you have $310 million of your $418 million of net income coming from non-recurring sources. So I could make the argument that the actual net income of this business is about $100 million. And if you look at 2024, when the revenue was higher, it was just over $100 million, and they had all this interest income. You go back to 2023, they didn't make jack shit. So while the underlying business is improving, albeit probably not sustainably, it is making more money. Now, when I tell you that the underlying business doesn't support the cost of debt, if you exclude the interest income from everything they have outstanding, take the two numbers I just mentioned to you, $100 million of net income. Now, this is after-tax net income. We go back to the balance sheet here. They have $4.2 billion of debt. Now, I think the interest rate on this is reasonable. I think it's probably 5%. I could look it up, but I don't really give a shit. But at 10%, $4 billion is $400 million of interest. So for this, obviously, the interest is much, much less than that. But either way, well, let's just look. Let's just look here real quick. Let's see if we can find the debt disclosure here. So here's your note. So these are convertible notes. So this is even worse because it's going to create more dilution. So here we go. Convertible notes. Let's see. I don't see an interest rate on this. This is interesting. And so it looks like these are actually non-interest bearing, which is fascinating. Interest expense. Here we go. Interest income. So interest income, net increase of 108 to 271 million. The increase is due to higher cash, blah, blah, blah. Partially offset, so by $42.2 million of non-cash interest expense. So these are warrants related to convertible debt. So the $4.1 billion or $4.2 billion of debt doesn't kick off any cash interest expense, but it does dilute you year after year after year because it is effectively picking warrants on the convertible notes. So the value of your shares every single year are going to be effectively amortized and approach zero over obviously a very long period of time. So we'll go back to here just very, very quickly, just so we have it on the screen. So net, you have convertible debt, which is the only way they could do it, because if they had $4 billion of debt, the rate on it's probably somewhere in the 8 to 10% range, if not a little bit higher. So you'd have anywhere between what 320 to 400 million dollars of interest expense. The business cannot support that. So that basically means that GameStop is not going to be able to float debt to raise cash to buy anything with GameStop or eBay, I should say. Now let's go look at eBay. Now this is obviously $46 billion market cap. So again, $100 million of net income after excluding interest expense or interest income and your tax benefit from your NOL carry forward from prior period compared to 46.7. So 460 times higher market cap than the annual earnings of GameStop. The math is just retarded. Yeah, I said it. Anybody who thinks this math actually works is retarded. They're financially retarded. Investment bankers will float anything, by the way, because they get a fee. They're not getting a success fee. They're just getting a fee regardless. So eBay. So we have $5 billion of current assets. So this is your cash equivalent, short-term investments, receivables, things like that. We go down here to debt. I think there was, so $6 billion worth of debt. So net, they could probably float a little bit of a debt if they wanted to, but they're pretty optimized here because when you go down here, and we'll just go to net income, there's no weirdness here. The interest income is what it is because they are going to have a couple $2 billion of cash at any point in time. So $2 billion of net income. You look at their net debt's probably 1.5 times. So best case scenario, they're probably pulling another $4 billion in debt from a borrowing capacity here. It doesn't get them to an uncomfortable level. It just gets them to a level where it's kind of whatever. So by combining these two companies, you're going to have $9 plus $5 billion. And all of the debt that you could raise with the balance sheet and the earnings of eBay, you already have saddled in debt on GameStop, picking you to death on convertible debt that's non-interest bearing. And what that debt does is it also reduces your ability to sell stock into the market. Obviously, they don't need to sell stock, but there's no way in hell that they're selling $40 billion of stock in a company that's worth $9 billion. $9 billion. The math just doesn't work for any of this. Now, did GameStop, let me look at this real quick. They didn't even file an 8K. So they didn't file an 8K disclosing that they had acquired a 5% interest or 10% interest. Not exactly sure what the rules are as it relates to public companies that aren't technically investment funds. But this entire thing is just a publicity scheme to get people to hopefully buy GameStop shares. eBay's probably sitting here laughing like, hey, buy our shares like any other investment fund. It's been dead money for a while. We're moving very, very slowly because we are a very large machine that's very mature and kicks off a ton of cash. But quite honestly, if GameStop was worth a shit, Fanatics would have taken it out years ago. It is a flaming bag of shit company. It's a melting ice cube. And quite honestly, their business model is selling stock to suckers who don't realize that it is a piece of garbage dying company. Quite honestly, no different than Blockbuster, which is kind of unfortunate because I like GameStop. It's cool to go into. I actually took my kid in there for the first time the other day. It was probably the first time I was in a GameStop in 5 years, 10 years. But that being said, this entire news article about GameStop preparing an offer, they can prepare whatever they want. Yeah, this is like a high school basketball team, preparing to buy to buy the Lakers. Like, you can make an offer, they're just gonna fucking laugh at you. So don't be a Timmy. The math doesn't work. The math is so far away from making any sense. It's just ridiculous. So anyway, guys, hopefully I didn't go too fast. Hopefully, I put this together in easy to understand form. So like the video, subscribe to the channel, join the Discord, and don't be Timmy. If somebody tells you GameStop's going to buy eBay, just tell them to stop being a dumbass.